As you look at this week, I look at the rates market, it's prepared for a slightly hawkish pivot, but is the credit market?
I think we would say it's not. Certainly we think when we look at the credit market today, we're very much pricing in, a softish landing. And certainly in our view, as we see rates higher for longer, that only increases the probability of something more problematic with respect to default rates further down the line.
At the moment, Mike, we haven't seen that crop up with default rates. We've seen the market hold steady, but as you say, if it's higher for longer, the maturity wall looks a lot more frightening. So just how bad does it get?
That's a great question. I think when we look at where the issues have been today, it's certainly been in the over-leveraged capital structures which are unsustainable in this new interest rate world. And so it has been somewhat idiosyncratic to certain sectors and certain business models with where we're seeing those stresses grow. But in our view, as rates start to percolate their way through the economy, through the refinancing channel or through cash flows of businesses, this becomes much more of a cyclical issue. Certainly not the case today, but we certainly could very much build a more negative view around the default rate cycle picking up from 2025 in a more meaningful fashion.
Now, Mike, you talk about pressure. You talk about pressures that you're witnessing in certain sectors to broaden. So you are seeing some kind of fissures relative to cracks. So where are those fissures that are perhaps most observable?
That's a great question, Manus. I think as we see it today, there's clearly significant cracks in the commercial real estate sector, and that's across both the US and Europe. And in many ways, this is percolating through not just the financing channel for these businesses, but also onto banks' balance sheets, particularly through the regional banks. I think alongside that, we also see significant pressure having built in what were once termed to be relatively stable sectors, such as media and telco. These businesses have certainly overborrowed in the low interest rate world, and are now seeing increased competition, which is certainly hurting their credit profiles. And the market is now starting to reassess its opinion on their credit worthiness. Interestingly, however, we're seeing actually very low dispersion in the most cyclical sectors. So the market, in our view, is very much pricing in a soft landing with no probability at all, in our mind, of something more malign occurring towards the end of this year and into 2025.
Mike, there's someone that Manus and I follow at Bank of America a lot. His name is Mike Hartnett. He puts out these weekly notes, and he coined this term ABB, anything but bonds, that nobody wants duration right now. And it's pushing people into more risky assets. They like credit, maybe high yield, because they can capture high yield, or they can even go into cash. How much does the disdain of duration, the anything but bonds, how much is that forcing this picture you're talking about with a market that keeps guzzling up riskier assets, that keeps pricing in a soft landing, frankly, because they just don't want safety in bonds?
I think there's definitely elements to that which are true. I think when we look at the government bond market, we're actually quite alarmed by the still quite negative term premia, particularly at the long end of the US Treasury curve. And certainly, with these unsustainable deficits, that just means one thing, and that's a huge amount of supply that the market has to absorb. And coupled with higher inflation prints that we've now had, three prints back to back, it certainly seems to be much more of a trend. We do think that this steepening in the government bond curve can continue and put pressure on duration. So certainly in this environment, we do see that shorter duration asset classes are more preferable. Certainly the cycle is still somewhat strong, courtesy of the fiscal largesse that we're seeing across much of the world. But that is very much a cyclical phenomenon. We do think that as we get into 2025, some of these more cyclical drivers will start to weaken, and we'll start to really see credit risk build in 2025.
Now, Mike, the debate is going to be whether the ECB has the room to move unilaterally and sooner relative to the Federal Reserve. And that will have a consequence. I'm curious, you look at the CCC space in Europe and you identify this as being that's where perhaps some fissures have appeared. How much would an earlier and more significant rate cut from the ECB do to that sort of space in Europe? Is there more of a desperation in Europe for these rate cuts to come sooner and in a better and a sizable quantum?
I think that's a great question because we do see actually disparity between the two markets from a relative value perspective. Europe has certainly been much weaker with respect to growth over the past 12 months versus the US, and that has been somewhat reflected, as you say, in the most junior parts of the market, such as the triple Cs. There's a big spread differential now between Europe and the US. And we do see Europe actually cutting or being able to cut earlier than the Fed. We think that June is very much a live meeting, and that should, for all intents and purposes, bring some degree of relief, let's call it, into some of the most the lowest parts of the European market. So we think that actually the value is now in some of these areas within Europe. And the US has yet to really price in a more problematic backdrop, which we think can very much be the 2025 story.